I welcome you once again to our advanced financial reporting lecture. I hope that everybody is okay out there. You have got a pen and paper in hand. You want to take down some notes. Before I get into the topic for our moment, I would like to share briefly a question on an illustration on assets for sale or assets held for sale, yes, and discontinued operations, that is IFRS 5. We have got that illustration in front of us, an item of property, plant and equipment measured under the revaluation model has a revalued carrying amount of 76 million at 1st January 2021, remaining useful life of 20 years. We just increase the size and with a zero residual value. 6 months from the date when we started our financial year, on 1st July 20x1, the asset met the criteria to be classified as held for sale. Its fair value is now judged to be $80 million, and cost to sale is $1 million on that date, meaning that the net realizable value in this case is going to be 79. That's good. Now remember that the provisions of IFRS 5 guides that when an asset is going to be sold, it's supposed to be separately recognized, and that it should be measured at the lower of the carrying value or the net realizable value, or indeed fair value less cost to sale. We use those two terms many times loosely. And so after 6 months, we need to ensure that we drop the 76 million by a semester depreciation, half a year depreciation. Hope you can see what is happening here. Initially, the carrying amount of the asset was 76. We divide that by 20, and then we multiply whatever we get by 6 over 12. We'll be getting 1.9. This 1.9 should be removed from 76 from 76 million rather, and we'll have this figure 74.1. 74.1 million. That means by the date we were revaluing this asset, the carrying value of this asset was 74.1 million. The asset is then revalued. Look at this. On 1st July, the asset met the criteria to be classified as held for sale. Its fair value is 80 million. It is then revalued from that figure, 74.1 to 80 million on that date. And there's a gain of 5.9 which is registered. All right? The difference between 80 and 74.1. And this should be recognized in other comprehensive income. Then we get on down there. On classification as held for sale, the asset is remeasured to fair value less cost, because ideally this is lower than 80 million. Of course you can think about that, but 79 is coming as a result of saying 80 million minus 1. As this is lower than the carrying amount, which is 80 million, we go for the 79. So thus there will be a loss of 1 million recognized in the statement of profit or loss. The asset is no longer depreciated when it is classified as held for sale and is presented as a separate line item under non-current assets held for sale, that is at 79 million within the current assets section. So I hope you will be able to remember that part. Illustration 2 says on 20th October 20x3, directors of a parent company made a public announcement on plans to close a steelworks owned by a subsidiary. The closure means that the group will no longer carry out this type of operation, which until recently has been represented about 10% of the total turnover. All right, meaning that it is significant. The works will be gradually shut down over a period of several months, with complete closure expected in July 2024. At 31st December, output had been significantly reduced and some redundancies had already taken place. The cash flows, revenues, and expenses relating to the steelworks can be clearly distinguished from those of the subsidiaries' other operations. Required. How should the closure of the steelworks be treated in the consolidated statements for the year ended 31st December? Okay, so we can see for ourselves, before the steelworks is being closed rather than sold, because rather the steelworks is being closed rather than sold, it cannot be classified as held for sale. In addition, the steelworks is not a discontinued operation because you have to meet all the provisions that are highlighted in IFRS 5. Although at 31st December 2023, the group was firmly committed to the closure, this has not yet taken place, and therefore the steelworks must be included under continuing operations. Information about the plant closure could be disclosed, however, in the note to the financial statements. All right, so I thought I'd just touch base on that one. Let us now discuss our day's topic. Which one is coming now? This one. Let us discuss today's topic, at least in terms of theory, employee benefits. Next time when I send you a record, I will be sharing how to deal with questions under this particular topic. Okay, so let us get a bit closer to that. When we employ workers, we have to remunerate them. That is, incentivize, appreciate labor. You know, the economy says that households supply labor, companies must pay for the labor. Our focus here is as follows. We need to discuss and apply the accounting treatment of short-term and long-term employee benefits. We need to discuss the defined contribution and defined benefit plans. We need to account for gains and losses under curtailments. We need to account for the asset selling tests and report the actuarial remeasurement gains, know how to report actuarial remeasurement gains or losses. All right, in our introduction thoughts, and I know that somebody out there might try to use this information for their own, benefit. Employee benefits include short-term benefits such as salaries and long-term benefits such as pensions. This topic is not covered in financial reporting, is not covered in financial reporting at the lower level, and so it might be a little bit new to some of us. In the strategic business reporting SBR exams, employee benefits could feature almost in any section and may form a whole or part of a question. Okay, so under short-term benefits, what do we see? These short-term benefits, which include salaries, bonuses, as well as allowances, these should be recognized as a liability as the employee renders service. This should not be discounted. We need to accrue for short-term compensated benefits that can be carried forward, such as unredeemed leave days. Those should be accrued because the company essentially owes the workers. Under post-employment benefits, something that is known as deferred salary, we have got the two types of plans. We have got defined contribution plan benefits and we have got what we call defined benefit plan. All right. Now the examiner loves these type of benefit, post-employment benefit, and questions are likely to come on that. So we need at least to appreciate in theory what the two means. A defined contribution plan is that plan that promises to pay the agreed amount of contribution. Once this is done, the entity has no further liability and no exposure to risks related to the performance of the assets held in the plan. The company in this case is only obliged to pay an agreed fixed amount towards the benefits of an employee. So we account for this type of contribution plan using what we call the accruals basis. Under a defined benefit plan, on the other hand, the post-employment plans, there is a promise to pay the amount of benefits agreed under the plan regardless of how the assets in the plan perform. All right. In simple terms, if the plan assets are insufficient to meet the plan liabilities, pay pensions in future, the entity will have to make up for any deficits. The projected unit method is used to compute benefits under the defined benefit plan, and of course, that is outside the detail of that is outside the scope of financial reporting. What we need to know as accountants is how to deal with the double entries. So I want you to know to remember this part of our discussion, and in our questions we're likely to be given the opening position for both the planned assets and the planned obligation. And now remember that time has got intrinsic value, and that time must be accounted for when you are computing the liability and the planned assets. And by the way, as I just discussed these, I'd like to remind you that the planned liabilities are normally measured at the present value, while the planned assets are normally measured at their fair value. Okay, so on the opening balances for planned assets and liabilities, we need to compute interest. So interest computed on planned assets is income, while interest computed on planned liabilities is an expense. So the net amount in the income statement will depend on which one is bigger than the other. Current service cost refers to the amount of contribution, the value of contribution made by workers during the current accounting period. And of course, when workers make contribution, we owe them, so we have to credit our present value obligation, and we have to debit our profit or loss. There might be some changes to the way that we compute benefits that could be backdated, and that could result in past service cost, which needs to be accounted for. How do we do that? Again, we follow the same route. Like in the above, we debit past service cost in the profit or loss, and then we credit the present value of the obligation. When the company makes contribution out of what the workers have given in form of labor, we must debit planned assets, all right, and then credit company cash, meaning that the cash of the company is reducing and the planned assets are increasing. All right, when we pay out benefits, the planned obligations, present value of the obligation will be reducing, and the present and the fair value rather of the assets will also reduce. So you debit present value obligation and credit the planned assets. Then we have got remeasurement. Under remeasurement, please get this one right. There will be a difference between the accounting figure for planned assets and planned liabilities, and that which is computed by an individual who has got expertise in valuation. So The difference will either be a gain or a loss, and that should be recognized in OCI. All relevant disclosures must be made. Okay, let me look at settlement, and I'm not going to take too much time here on the theory. A settlement is a transaction that eliminates all further legal or constructive obligation for part or all of the benefits. Okay, any gain or loss on a settlement must be recognized in the profit or loss. The asset seeding test. Under the asset seeding test, we are saying that the benefits under the net position rather for a given plan, whether it be a liability or an asset, cannot exceed a certain amount. Okay, it's very important. So the net selling test shall be measured at the lower of the net reported assets, and the present value refunds are variable from planned or reduction in what we call future contribution. I'd like to thank you for listening to our lecture. Next time when we meet, we're likely to look at provisions. Thank you once again, and let me know if you have got some questions.